talk again about momentum, technicals, zero-date options, and pretty simple. Momentum right up front, improving. This is a very choppy market. It does not seem like it wants to get above that 6,000 level just yet. A lot of chatter, a lot of talk, a lot of concern about going in the other direction. But I will say this. We have a bill that they're trying to pass that would run multiple $trillion in deficit, and that's actually bullish for the market because spending money is bullish for the market. Good morning, Peter. I hope you guys are doing well. So we got a little bit of weakness. It's just been this kind of drag. This is very similar to some of the things we saw back in 2021. Takes a little bit of time. Things that are strong, WFC, generic, GNRC. This is a company that will definitely be in the conversation with what's going on with this bill in Washington on alternative energy. NCLH, again, watching for some strength coming back, momentum, cyclicals. Spend now, die later. Well, that's exactly the point. TPL, Uber, Caesar. We've been talking about Uber. The breakdown has continued. Obviously, this was a stock that Gianni was on and just rode up into the 90s, coming off of that bottom, down 60 up to 93. Sometimes things just break down. So we got back under that SMA, that EMA, and now the stock moving in the opposite direction. A reminder, those strong momentum stocks, when to take aim at them. Well, I'm going to talk today about these specific technicals, why they matter, why you need to have them up, why they are so critical to your success. There are 6 of them. I was asked in an email to go over every single one of them. It's not going to take very long, but as you could see, all of them are momentum oscillators, and all of them, when they start moving together in the same direction, very good things can happen for traders. So 6 indicators we'll talk about today. 4 of them are correlated according to the research of JD Henning. I like to add in the MACD, and I like to focus on the ADX as well. We'll talk about that. But key watch list today, GT, NWPX, a lot of, if they're all momentum, aren't they redundant? No, they're not. No, they're not. And then we'll talk about why. So once again, AA, Alcoa, GT, we're looking at the steel names. Just a lot of momentum and a lot of capital flowing into this arena. So that is the momentum overview. Interesting that Caesar's breaking down the exact same time that NCLH looks strong. This just kind of proves the money's just kind of flowing in various places. Market makers are hedging. And the big questions are, what are we going to be looking at as we look out to Third Friday? Now, what are we at? 16, 17 days away. Could be a little bit of fireworks, but not anticipating too much at this point. Momentum is breaking. Liquidity is weakened in May. We'll talk about why that's important momentarily, but this is the headline of the day. And Musk, you're going to hear about this. I said at the beginning of the year, the kind of I didn't call it a black swan, but I basically just said at some point this relationship's going to go sideways. And this isn't a political conversation. This is just kind of how things work. I have long argued that we don't control anything political. I don't get upset about politics. I don't think about politics. I only think about politics in the worldview of markets. And what I know post-1993 is that the Clinton administration was absolutely scared as hell of the bond market coming out of the early recession in the 1990s. If we go back and we look at the different ways that the central bank has behaved, inflation targeted started in the 1990s. QE started in the 2000s, and now we have manipulation of the treasury market that has been going on roughly since 2018, but has been picking up steam since post-COVID. If you spend your day getting upset about politics, that's okay. I have to talk my mother off a cliff every time I talk to her about something. The reality is this: we don't control on it. All I can do is give you the keys to actually understand how policy works, how Washington works, and why it is important to simply follow the money. That's it. And at the end of the day, the focus here is going to be more spending. There was a key line that Biden said about 7-8 years ago that still sticks with me. Doesn't matter what you think about Biden. When the mask slips on policy, you have to pay attention to the words. And the word was, do we have to keep spending in order to ensure that our economy remains sustainable? You're damn right we do. Well, That is kind of the way it all works. Monetary inflation, expansion over time, that is going to be the name of the game. We are trapped in this dollar curse. We are trapped in the world of twin deficits. And yes, Diamond has warned next time could be the one that breaks it. We've had five events happen that cracked the bond market in the last 5 years. And once again, so long as you remain the cleanest shirt in the laundry, you can continue going. My continued focus is again around momentum and around liquidity. And so long as this game is being played, you got to keep dancing. So we're going to keep dancing overall. So once again, when we get into an environment where I have deep concerns about the bond market, and I've had multiple ones going back to 2020, we're going to pay attention to the FNGD. That is going to be one of our key ways to manage this, to focus on from a momentum perspective. We're going to know how to hedge. We're going to continue to play the monetary inflation game, and we will continue to focus again on how do we manage our capital? How do we ensure that we are buying at points where policy says we should? Now, I want to just speak briefly about insider buying. We talked about this. We had a whole week dedicated to insider buying in 13Ds. We had a cluster buy that happened around Shenandoah Communications. Stock popped 3.3% yesterday. We mentioned the stock briefly yesterday. Overall, insider buying remains relatively light, but we are looking for these types of activities to trade spreads to the downside, to sell puts on names like this. And with a company like Shenandoah, if you're still trying to take action on this, if you can sell a put, and you might be able to name your own put price if there is anything in the chain, when you see anything like this, go back down under where the stock was purchased and go back down under the 20-day moving average. The focus here is if you want to be able to take possession of the stock, you do it down here. You don't try to do it up here where momentum remains very, very strong. You want to be below certain technical lines. We'll talk about that in a moment. Now, yesterday, we were talking about the idea that momentum and liquidity and how the markets operate. And I spent a little bit of time yesterday trying to articulate this in a more unique way, right? To really help people understand how I perceived momentum. And in a column I wrote yesterday out in the world somewhere, I mentioned that when I was younger, I wanted to go to college out in Malibu. I wanted to go to a very small school out there, Jesuit school. And I told my dad that I was interested in it because I went to a Jesuit high school. And he said, well, have you ever been out to Malibu? And I said, no, I haven't. He laughed and he said, well, you won't get anything done. When I turned 23, 24, after I got out of college, I went out to California wearing a seersucker suit, rented a white Mustang, and drove as fast as I could up the Pacific Highway up to Pepperdine University. And there I sat up on the hill and looked down on Surfrider Beach and realized, yeah, I wouldn't have gotten anything done. I would have been done at this school within a good, 2 to 3 weeks. But that said, I did want to go back and just briefly note that when it comes to the worldview, the easiest way to describe it to people is through the idea of surfing. So when we talk about the concept of liquidity, liquidity really is the tide coming in and coming out. It's the easiest way to think about it. Liquidity is water itself, and it is all of the money sloshing around the system beyond the M2, and as the way that Michael Howe has defined it and the way that Posner has defined it. This is all of the capital, the money that's even in your couch. At the end of the day, anything that can find its way into risk assets. So this is central banks, money markets, corporate credit, hedge funds, shadow banks creating private credit, lending windows, everything. High tide means deep water. And when there is deep water, waves can form. You can surf. Low tide means shallow water, exposed rocks, danger. So in markets, liquidity is the total amount of money that can buy things. When the Federal Reserve prints, known as quantitative easing, it provides support to the global system. The Federal Reserve's job at the end of the day is to manage the global financial system, to provide capital, to provide liquidity, and to be a backstop, not just for the U.S. economy and not for you, the taxpayer, but really for the financial system itself globally. This is one of the responsibilities of the reserve currency. So when the Fed does QE or they lower interest rates, which impacts the quality of collateral, they're adding water to the ocean. And more money means more flows into stocks, bonds, real estates, prices rise, assets ultimately will hide the debasement that is happening to the currency as a result. So the first thing is to remember this. Before you look at any stock or chart, ask yourself, is the tide coming in or going out? In May, liquidity dropped, and typically there is a lag on this. So we could see a little bit of weakness in June or July because of concerns about the broader amount of liquidity that is in the ocean. Momentum is different, right? Momentum is the wave. It is the money that is moving. It is what you are trying to ride through any environment. So don't try to predict the wave. You have to recognize it. And there are a lot of different tools that we utilize in order to recognize it. One of the key things that we focus on is just the in and the out of capital in the S&P 500, which is pretty simple to measure when you look at it on a bell curve. So if you look out on the bell curve and you're going out to the very far left, we're looking at the number of stocks that are breaking out versus breaking down in very specific conditions. A poor man's way to do this is simply to look at the S&P 500, pull up the technicals, look at the number of stocks that are up 5% on the week, numbers of stocks that are up on the month, and then assign a beta coefficient or a beta figure, and then every sector has its own coefficient. So I'm going to just simply note every sector has a different coefficient. Therefore, I'm not going to be able to completely break down the number, but this will give you a good sense of what is happening in the market at any given moment. Why 5%? Because that's what the academic data says that we need to focus on. We have 18 stocks currently up 5%, beta 1 to 2, and up on the month. That's where things start to change a little bit. It drops it down to 16. If we move it over to -5, things change a little bit, right? So we have 18 there. Now we're looking at month down, and we have 3. So we're at 18 to 3 on stocks up 5%, up on the month, beta 1 to 2, and down on the month 3 with Uber, TPL, and HPQ. This is important because it takes a lot of money. It just is a lot of money in the S&P 500. It is a lot of money when you're talking $100 billion companies. Now, when this happens, if we go into a negative figure and that, talking about which direction things go, we then pay attention to the FNGD. Well, we can look at the Mag 7 first because the Mag 7 is such the overwhelming weight in the S&P 500. But I look at the FNGD because the markets are so financialized that I want to pay attention to the underlying bonds and the derivatives in the markets that are linked to these companies. And this indicator, as a confirmation tool, has helped us avoid significant negative momentum events. So what I'm talking about here is this was the excess liquidity drain in February. This is the trade crisis. This is the Nikkei crisis last year. I can go back all the way through every major event that has transpired in the last couple of years, specifically 4 Sigma events, have all happened above the 20-day moving average on the FNGD. Every one of them. So this is a very important indicator for us. And as we talk about momentum, right, this is the difference between a flat ocean and building waves. You can measure it with technical tools, but really it is about a crowd psychology. Millions of traders are starting to move in the same direction. We have built an equation that measures market temperature. It is like checking the surf report right before you go to the beach. Good surfers don't guess where waves come from. They watch the ocean. They see the swells building. They position themselves. Positive momentum looks like rising prices on growing volume, sectors rotating, money is flowing from defense to offense. And when there's negative momentum, as again, we focus on and we confirm using these tools, that is where there's failed rallies, distribution, and choppy action. The reality is you do not predict momentum. It is measured in hard math. You recognize it and you move with it. Now, the third part of this, and this is the easy one, when you are looking to understand when it is time to go back into the water, well, if you have ever been to Hawaii and you have ever been to California and you've ever been on a beach, pay attention to what the locals are doing, because they know things that the tourists don't. And they're the ones who are always warning, hey, you're an idiot. Get off of our beach. You don't know where our rocks are. They know where the currents pull. They know where the break gets dangerous. They know what days are magic. The corporate insiders are the market locals. CEOs, CFOs, board members, they live inside their companies. They see the numbers before earnings. They know what's coming. And this was the bottom, April 9th. Massive insider buying to selling ratio shift in addition to a policy change. And that's the one thing we're always looking for in these big negative downturns, 20% downturns, is a policy shift. It can be from the Fed, it can be from the Treasury, it can be from a foreign central bank, or it can be something as simple as calling off Liberation Day. So when multiple insiders start buying, pay attention. They had information that the president was doing. They knew the previous policy changes had included these pivots. The locals know their beach. That is the big macro view of the world. But then when you drill down into the indicators themselves, right? The question was, aren't they, because they're all momentum indicators, aren't they all related? In some ways, yes. But the reality is, according to the data, the work from Henning, there are multiple indicators out there, multiple fundamental analysis, things that you can assess, big things that you can do at the macro level, looking at unemployment, or you can look at specific technicals. What his dissertation had shown, and again, this is peer reviewed, relative strength index, money flow index, average true range, and the ultimate oscillator are the four that have the highest relationship. And if you watch these four things, and they are all moving in tandem, and they're all moving above into positive territory and showcasing strength, that is positive, because you have not just trend, you have price strength, you have volume strength, you know whether or not this is a real sustainable rally or not based on the ULT. And just to break down every one of them, the relative strength index is like checking your waves are too crowded, overbought, or empty, oversold. Above 70 means everyone's already surfing this break and they might wipe out. Below 30 means it's uncrowded, could catch the next set. Measures momentum like reading the lineup. So again, we pay attention to RSI and MFI, and I'm going to show you the RSI and the MFI on the energy sector in a moment and why it's so important. The MFI watches wave size and how many people are paddling at once, right? This is volume and price. High volume with rising prices is like watching locals charging waves confidently, and low MFI means surfers are sitting outside waiting. Money is not flowing into these waves yet. But this is important. If you know anything about energy trading, always pay attention to when the XLE is both oversold on both the MFI and the RSI. This has been a period where the CTAs and the people who have short positions start to cover because there's no one else buying. And when there is no one else buying, well, you better freak out a little bit, because that becomes the point. Particularly if you're a short, you're trying to force that short covering, or you're trying to get people to step in and bid, and there's no bid, right? There's no strength. There's no stocks going above 5% in the energy sector anywhere. There's no confidence. Well, that typically is where we see short covering start. You can get back above the 20-day, and if you do, pay attention to that MACD. Pay attention to the MACD, which I'll explain in a moment through surfer concept. But basically, yes, you're still kind of oversold here on the RSI and the MFI, but the MACD is turning positive and returning move. This is where big moves can happen in the XLE. $6 move in about 2 weeks. You can make a lot of money with that if you're just buying a call to the upside at the whatever is $1 2 weeks out. Whatever's at $1 2 weeks out, that becomes your bid. Now, the MACD is like comparing today's swell to the weekly average. When short-term swells cross above the long-term patterns, you want to paddle as hard as you damn well can. And that's a perfect example right here, right? Pushing up, now you're crossing the 20, now you got some strength. And look how quickly from there, the RSI and the MFI move to overbought. That's how fast it can happen, particularly in energy, tech, communications, things where lots of flow happen and where a lot of short covering transpires. The ADX is the thing that I like to focus on because it provides a nice little clean analysis. When the green is above the red, good. But here's the thing. This is what we were talking about. You want to start to pay attention to when all of these things align. At MACD, move positive. moving above the 20-day, moving above 50 on the RSI, moving above 50 on the MFI, moving above into positive territory on the ADX. Where does that take us? Right here, right above our 20-day EMA. That's where I can have confidence and conviction now to basically look to buy a call, to trade to the upside, and then keep that 20-day EMA or the 20-day SMA as my stopping out point. All of these things move in tandem, but you want to ensure that MFI is showing strength. You want to see that volume is improving. Our price can move higher without volume. We know that. But that's not instilling really true momentum. You will see on many occasions where volume will pick up, but price goes nowhere. That can be hedging. That can be any number of things going on in the markets. ADX measures whether you're surfing clean, powerful waves, strong trend, or choppy, confused ones. Above 25 means solid rideable waves in one direction. Below 20 is windblown slop. ATR tells you whether or not you're trading two-footers or 10-foot bombs. High ATR means big volatile swells, huge potential but dangerous wipeouts. Low ATR means small predictable surf. If you're trading on ATR, keep tight stops. And the ultimate oscillator is like using basically three surf reports all at once and averaging them out. That combines short, medium, and long-term patterns to spot when the tide's turning. And when all three of these things align, that's where you can have a lot more confidence in the market and in trading in a specific direction. ULT, ATR, MFI, and RSI, according to Henning, have very strong relationships. The ADX is a tool that I like to utilize with the MACD for further confirmation. And all of this works on intraday. All of this works down at the 5-minute as well if you want to just trade the 5-minute. It's very important just to keep in mind that it's all about building conviction. It's all about having the confidence to trade and ride momentum and not say to yourself, well, I'm worried that, we might break under. Look, to simplify trading, if you are new to this or you're new to buying calls or you're new to hedging strategies, take all of these, circle where they are moving above and into positive territory, and then set a very tight stop under the EMA. And then you're either going to ride out and you're going to have a hell of a ride, or you're not going to be able to get back up off the board, but hey, at least you didn't drown because all you did was ensure that you kept everything very, very tight and you did not make any over speculations. Awesome oscillator, unfortunately, no, we got to go with ultimate oscillator. Maybe I'll have to invent something. All right, so it is sitting here looking at this. Futures are flat. Gold price is up at 33.82. Silver at 35.51. Once again, all roads point to monetary inflation. And I was talking about this. When it comes to the broader market, at the end of the day, where my focus is going to remain, I'm not going to be doing as much in the softs as I used to do. I want to be paying very close attention to gold, silver. I want to be paying very close attention to platinum and copper. Copper will be driven heavily by Chinese central bank policy. But then it really starts to center around a lot of these pipelines, a lot of these assets that kick off a lot of cash on a monthly basis, and then trading that cash as it comes to the upside or downside. In addition to that, I'm paying very close attention to things that are in the digital real estate space because, again, this is where the sovereign wealth funds are going to be placing a ton of money in the United States. Big focus on the utilities. Again, if you are trading utilities, which I tell you you should, pay very close attention to the XLU or the UTSL, which is the leveraged ETF for the utilities. If this breaks down, start to pay attention to where there is no bid anymore. Pay attention to where the insiders start buying up again, because the UTSL, since that low in April, as boring as utilities are supposed to be, the UTSL is up roughly 33%, and the XLU is up over 10%. Forgive me, a little bit more than that, about 15% since that bottoming in April. Utilities will remain a strong play, and I like the construct here because so much cash is going to be kicked off in the utility sectors moving forward. All right, so a little attention. 1 hour, Both 1 hours are above. That is intraday momentum. Yes. So intraday is different than daily. Intraday is kind of where a lot of that chop has been coming from in recent days. But, overall, it's a good sign when you have this short-term momentum. You have these kind of sell-offs. It's the daily that you got to pay very close attention to, because that's, again, nothing great happens in the market when you're under the 20-day and 50-day EMA. All right. So last thing we want to discuss today, we got about 9 minutes, and I want to walk you through this. This is very important because we've had this beautiful setup in the last couple of days to really prove a point that, I try to educate people on just kind of how the markets operate, how things move. And I always look for the opportunities to do it live. And Friday was a perfect example because we actually had it. But interestingly enough, it's happened now 3 days in a row. This is volume weighted average price. This is the blue line. These are the deviation bands around volume weighted average price. And interestingly enough, yesterday, right at past 10 o'clock, in that 10 o'clock to 10:30 window, we tapped the third standard deviation and moved briefly into the fourth standard deviation of price on volume weighted average price. And what happened? The market turned right back around, climbing that wall of worry, and popped again. 0-date options for the win once again. Going back to Monday talking about this, there was an option, the 585 that we were discussing. The 585 on the SPY had gone from $2 to $6. So 0-date options, particularly trading around various strategies, this is going to be very, very critical because so much focus is now in 0-date, not just from the retail side, but also from the hedging side of large institutions. People are very deeply concerned about these wild swings, these wild moves. So a lot of things have been moved forward into shorter term periods rather than taking that focus on the long term. I noted this the other day. Back in the 60s, the average time that people held stocks was 8 years. Well, it was very difficult to dump stock. You had to pay a lot of money in order to sell it because they were largely illiquid. But today, in this hyper financialized economy where everything's digital and it's free to trade stocks, the average holding time is less than a year. So it's fitting that the average holding time of options is now moving into less than a day as well. And as I've said, you're looking for in this environment these sell-offs to transpire using volume weighted average price. And on the SPX, which is what I'm focusing on the SPX, when I get down here into the fourth band, that is where I'm buying something that is in the money, right at the line. So here's the SPX, and you turn around, you look at the SPY. Doesn't matter where the SPY is because it is a reflection here, right? It's tracking the S&P 500, but buying down here, whatever is in the money, first tick, 585, and as a result, you had a pretty massive move yesterday. Why 0-date? Well, again, this all goes back to the man versus machine thing that we talked about. Algos are dominating the trade volumes, and we get down in that fourth deviation. That is where we are actually triggering buying. This is something that Stanley Druckenmiller talked about back in 2018. There's been a lot of weakness in terms of the way the trend operates. Markets don't go down in a straight line. They take a stair-step pattern down. You have selling, you hit a technical level, you pop back up, everybody gets optimistic, and then the funds sell back into strength. It is a stair-step pattern down, lower highs, lower lows. So when you get into the extreme lows, particularly intraday, you are likely to see some sort of bidding. And the way that I like to trade this is if I'm staying in the money, I buy 3 contracts. I exit the first at the first standard deviation band. I exit the second at the VWAP, assuming that we get there. Doesn't mean we're going to get there every time. It means that I'm going to use these deviation bands as stops along the way. I might pop here and then roll back over. That means I'm selling my second leg, and I'd be exiting my third leg back here where I started. So it's a pattern, right? 1, 2, I'm out there. Now I have one that I can just let ride. I will ultimately sell it wherever it exits at the volume weighted average price, or if we get up into the top of the third standard deviation. That's the way that I've focused on day trading with volume weighted average price and 0-date. But here's the thing with 0-date, right? Within this world, we talked about VWAP, 0-date options to expiration options, right? They're expiring today. They expire the exact same day that they are traded. They are common on SPX, SPY, QQQ, and major indices, and they're used for intraday speculation, hedging, and volatility trading. This is how significant this has become. There were 388,000 contracts traded daily in zero date in early 2022. Q1 of this year, average daily volume reached around 2 million contracts, marking a more than five-fold increase over 3 years. This year, right now, last month, zero-date options hit 60% of all S&P 500 options trading volume. So that is a record. And from a share perspective, back in 2016, when I first started covering this as a journalist, in 2016, zero-date options were just 5% of total SPX options. By mid-2023, it hit 43%. By February of this year, it hit 56%. And by May of this year, it hit 60%. And keep in mind, we're probably going to very soon with NASDAQ have Tesla, NVIDIA, Apple, all the Mag 7, possibly some of the big energy names with zero-date options too. So we're going to be talking about even more volume. So this is something that you need to understand, not just the fact of that all of this volume exists, but this is going to be impacting your trading because there's going to be so much volume and focus on price at the end of the day and where stocks are moving. Yeah, it's going to be moving very, very fast. So it's important that you educate yourself on this. And I'll talk about how you're going to be able to do that today. The core thing here is instant exposure to intraday moves without overnight risk. This is one of the key benefits of this. There's high gamma sensitivity. It is ideal for short-term directional trades. I've talked about that using volume-weighted average price. It is efficient for hedging news and economic releases. And there is very high liquidity in this environment and very tight spreads in this environment. This has become a much more liquid environment. Now, before anyone gets worried about zero date, it's like I learned to love deflation over inflation once I learned more about it. The more that I've learned about zero date over the decade, I've just learned to try to know how do I exploit it? How do I take advantage of it? Zero date is not gambling. A lot of people think it is. It is not. It can be used for structural hedging, risk control, and once again, if you have a very interesting strategy, the way that I'm talking about here with S&P 500, again, very low downside because I'm buying an in-the-money call and I'm setting a very tight stop. That's a strategy that is lower risk, higher reward. That's what we're focusing on. There's a myth that this is just dedicated to Citadel and the big algos that are using them. Retail is driving the largest share of zero date volume. But the problem is most people in retail don't know how to use them. And then the obvious myth is that they're too risky. Again, it's all about having defined risk trades. Things like spreads, things like butterflies, things like, again, what I just talked about using one directional. These are the things that can mitigate loss potential because I know if I'm making a trade zero date, I have the capacity to know, all right, I'm willing to lose 25%, but in the case of that 585, that paid over 200%, the third leg of that trade. So again, the core thing here today, Don's got something coming up today. I think it's very important that you join it. It's Don's zero date focus today. He's going to be live today, I believe at 1 o'clock. And just click the link, get in the room, and learn about zero date because it's going to be this is going to be the future of trading, whether or not we like it or not. There's going to be so much focus on that short-term intraday analysis, and I do find it relatively interesting, given the fact that CNBC and all these other media outlets, they look at all this stuff and they don't talk about this enough. They don't really understand where capital is flowing and why it is so important moving forward. There will be more focus and more dedication, I think, in financial media to capital flows and capital analysis in the years ahead. And that's kind of one of the goals, to spearhead that and to drive that. Because at the end of the day, price is what tells the story. I've had very significant conversations in the last couple of days with a variety of different media outlets and funds, and they keep saying, well, why is it that people are losing so much money on trading? Well, I think it's because of the media. Because again, when we go back, I just mentioned this, the XLE, when we are oversold in energy, I guarantee you that somewhere they're saying, well, oil's going to go to 40. And then when oil gets back up here, They're saying, well, oil, or the OILU or the XLE, they're saying, well, oil's got to go to 140. This is why you have to learn the technicals, and this is why you need to learn that if there's going to be this much concentration in capital happening in the intraday, this is where there's going to be an ample amount of money, opportunity to make money. So if you are a person who has dividend stocks, if you're a person who has closed-end funds, if you're a person who's trading energy transfer and you're getting capital kicked off to you, that is the cash that you can use not to speculate, not to gamble, but to take calculated positions to the upside or to the downside based on where the capital is flowing that day, using the tools like volume weighted average price, using some of the things that Don talks about, because this is going to be dominating the narrative within the next year, particularly with Apple and Tesla and all these other companies bringing zero date on. So join the event today with Don. And again, click the link if you want to understand how to set up the VWAP deviation bands. I hope that you guys have a great day. Mark, good to see. Everybody hated zero date when they first saw them. Now you can see how big gamma can see. Exactly. Read what Mark is saying. But learning how to hedge short term and learning how to take advantage of the short term waves, that's what's going to set you apart as a trader in the future. I hope you guys got a lot out of today. I will be back at 12:30. Don's coming up momentarily. Have a great day. Stay positive, and I'll see you tomorrow again, 8:45 here at Market Masters. Enjoy.